Rob Subbaraman joins us, Head of Global Market Research at Nomura. Rob, good morning. Thank you for joining us. At the beginning of the year, things were different. No war, no energy shock. Inflation was considered to be transitory. Looks like the settings of the table have changed 180 degree. So looking at what we are working with, energy shock, high crude prices, Fed is looking at tightening interest rates. What is in store for rest of the year?
Yeah, I think as the IMF has started calling it, it's a crisis on a crisis. And we're going to hear more about that when the IMF releases its World Economic Outlook report later this week, where they're likely to downgrade growth quite substantially globally. I'd say it's a very challenging environment globally and for India, and maybe more for India than countries outside India on average. And I say challenging because it is a kind of stagflationary shock where inflation is clearly going up and the rising risks for growth are on the downside. So it's going to be very challenging, I think, for policymakers to navigate. How much emphasis should the central bank put on inflation vis-a-vis growth? And also for corporates and households to navigate as well.
Rob, are we in for an recessionary shock for the world? Given that energy prices are high, Fed will increase rates. Are we in for, when the cycle reverses, Rob, you don't know what could be the extent of the reversal?
Yeah, that's the burning question that I get asked a lot from Nomura's clients is, what's the chances of recession happening? I'd say a few things. So one is looking at the typical recession indicators at this point, such as yield curve measures or labor market indicators. The risk of a recession, particularly in the US, in the next 12 months, still looks relatively low. I would put it at 15% or lower than that, based on these indicators. But the other point I would make is that the likelihood could change fairly quickly, right? Markets, the thing that actually could change the recession risk is markets itself, right? If you can imagine a scenario where the Fed starts raising rates quite sharply, let's say 50 basis point hikes, we expect 3 back-to-back 50 basis point hikes. And if that starts to really weaken the equity market and cause corporate credit spreads to widen, and particularly corporate credit spreads are very important. It's a useful indicator. If they start to gap out, then that risk of recession starts to rise more quickly. So a lot really depends on the Fed and how the markets respond. In a way, the Fed may cause the recession.
Good morning. This is Nantara joining in. Now, very recently, what you've spoken about is incipient signs of economic nationalism in emerging markets, where you're also now talking about foreign portfolio investors maybe looking to increase their allocation for emerging markets at the cost of developed markets, simply because countries are looking to invest in their own country and the neighborhood. What exactly does that mean, and wouldn't India become one of the biggest beneficiaries of this trend?
Yeah, so potentially I think India could be a beneficiary of growing economic nationalism and particularly around EM. So I'd note a few points. So firstly, if you look at US foreign portfolio liabilities, they have surged substantially, and particularly foreign holdings of US equities have gone up substantially, not just foreigners buying US equities, but also because of the price appreciation since the global financial crisis and all the QE, the value of the equity has gone up substantially. So, and if you look at it, emerging markets hold as collectively a very large share of US portfolio liabilities, close to 2/5 of US total portfolio liabilities, that is equity and debt, is held by EM investors. So there is a lot of potential scope for EM to diversify away from the US. If you add that to also what we're seeing where financial sanctions are being weaponized, we're seeing that against Russia, and who knows whether that will be the new regime where the US uses its economic might to get its way. You could argue that emerging markets may start wanting to diversify to reduce that risk. For instance, emerging market central banks may want to diversify some of their FX reserves that are held in US dollars. And then you've got commodity prices, which have surged. You have climate change happening. Do emerging markets want to hold more of their commodities in storage? So, higher inventory levels of energy, of food. So these are all parts of the economic nationalism. And you could see regions such as Asia wanting to collaborate even more with each other, not just trade, but also investment. So that's what I have in mind. And you're right that I think potentially if China is targeted more by certain advanced economies, you could see India being a beneficiary of this economic nationalism.
But then, Rob, what you're saying is going to be so significant. What started off late last year, the way foreign investors pressed the sell button, they sold more than they did during the 2008 crisis. Therefore, what you're predicting, we started to see the FIs make a comeback. Is that going to be accelerated, whether they're tracking EMs or EMs are actually stockpiling commodities the way you're talking about?
So the one thing I would say about what I was talking about, economic nationalism and emerging markets investing more in themselves. So intra-Asia trade starting to be intra-Asia investment as well. It's not something that is going to happen in the coming months or even in the coming quarters. This is a medium-term trend. I'm talking over the next 2 to 3 years. So I want to be very clear on that. I would say in the near term, EM is facing significant challenges. And I think you mentioned it earlier, an aggressive Fed hiking cycle and a China economy that's under considerable pressure now with growth unusually unlikely to hit the government's target of 5.5% this year. So that's quite negative. And I'd say for India in particular, we are concerned that the central bank is behind the curve. We have raised our inflation forecast for this FY23 to well over 6% now, so well over the RBI's target, and that's for the whole year. So, India has very high inflation expectations. It's got twin deficits, current account and fiscal. So it's really, I think, important that the RBI catches up here, and that's what we're expecting. We're expecting 200 basis points of rate hikes by the RBI, essentially 25 basis point rate hikes at each of the next 8 meetings.
So Rob, what is the best way to perhaps make your portfolio inflation proof? Because if rates are going to go down, asset prices will come down, bond markets will not give positive returns. So how can one really say, okay, I'm aware of the risk in the world, but I've got money to manage? What do I tell my clients? How can I justify my fee and make the inflation portfolio inflation proof?
Yeah, it's not easy. I think we're in a very challenging time for investments. There's obviously inflation hedges. But many of those are already quite expensive if I think about commodity prices as an example. So it's not easy. I think you're right to point out that it's not just equities, but also debt markets that are vulnerable here. Credit markets haven't actually widened significantly at this point, but that I think is the risk as growth slows down. over the course of this year and next. So it is a very challenging environment. I'm not an investment advisor. I'm an economist, so I won't delve into what advice you should give. But I would just say that this is a very unusual environment. And the thing that I think makes it also very challenging, especially for a lot of young investors, is we're in a new regime where inflation is way above the target of the world's biggest central bank. So we're used to the policy put, the Bernanke put, the Yellen put, the Powell put, but I think that's retired now, and we will get tough love from the Fed. Even as growth slows, as financial conditions tighten, the Fed will not blink. It will continue to raise rates to at least get to neutral, probably restricted territory, until it's confident that it has inflation, the inflation genie, back firmly in the bottle.
Okay, Rob, we're going to have to leave it at that. Thank you so much for joining us live today. That's Nomura's views of the economy at large, and we're also, of course, tracking capital flows and how to make your portfolio recession-proof.